So that's 80% of the time. 80% of the time agency, 20% risk. But it's 90% of the time. So only 10% of it is spent actually doing what's called, well, the polar opposite, trading proprietarily. As in, everything that the bank does proprietary to doing business with clients. That's why it's called proprietary trading. And it's the polar opposite. Because the traders are using the bank's balance sheet to do the opposite of a negative selection portfolio. So what they're trying to do is use the bank's balance sheet to make back the $20 million that they lost doing business. So the vast majority of the time is spent supervising algorithms. 10% spent managing a positive selection portfolio. And they're typically long-short portfolios. So they want to be longer stock, they want to be shorter stock, they build that portfolio and they run it. And typically it's a 1 to 3 month time horizon. And this is what a typical guy's business. So if you just walk up to a guy on a trading desk at an investment bank and say, what do you trade? The guy says, I'll trade the top 100 S&P 500 stocks for XYZ bank. This is what the business will probably look like in a typical fiscal year. Commission generated, 50 million, with a retention ratio of 70%. And then the same amount of commission coming in, roughly speaking, exposure in the proprietary trading account. Trying to make 20%. And then the net loss ratio. So you end up with a total revenue of 45 on a turnover of 50. Which is a pretty good performance. That's a decent year. The bank then gives that trader a discretionary bonus. So they just pull a number out of thin air. It's not fixed. It's just made up. So when you sign your contract to go and work for an investment bank, your contract literally says your bonus is at the discretion of the bank. And you have your bonus meetings leading into the day you'll get told, and then you get called in and get told. And that's the day that everybody in the year looks forward to, or dreads. Basic salary is paid, which is usually less than your bonus. If you're getting paid a bonus less than your basic salary, you shouldn't be working in the investment banking industry. And then an overhead cost, because it costs the bank $1 million for you to sit there. So total profit attributed to a trader might look something like that these days. In my day, it was double. So really, what have we learned here? Well, in emulating professional traders at an investment bank, you're not really trying to emulate at all what the professional trader does as a market maker. Your objective as a retail trader to make money with your own money is more aligned with their positive selection portfolio. So 90% of everything they do has got nothing to do with your interest, unless you want to go and work for a bank and become one of the guys that supervises electronic orders. But most importantly, or one of the most important things, you'll see that a trader in an investment bank has a basic salary. I'll make a statement and never, ever, ever forget it. Every single professional trader in the world has a basic salary. Every professional trader. If they don't, they're being legged over by the company that's hired them. And if they make no money in the proprietary trading account, they don't get a bonus. If they make money, they get a bonus. We'll come back to this later, the issue of a basic salary. So what does a professional trader at a hedge fund do? First things first, protect the capital of their investors by making money in markets that go up and markets that go down. But professional traders at hedge funds, usually called PMs, portfolio managers. Why? Pretty obvious, they manage portfolios. They don't go home at night with no positions, walk in the next day, get massively long a market, and then close out at 3 in the afternoon and go for drinks. They're running portfolios. They take overnight risk, and the time horizon can be anything from 1 to 18 months, usually. But it's usually 3, a 3-month time horizon. There's no market-making activity, but their function is extremely similar to the prop trading function at an investment bank, the positive selection portfolio. The only difference is the structure of the business that they operate in. Essentially, the trading, the way they do things, the processes they go through to choose what they want to buy and short are exactly the same. It's no coincidence why there's so many of the world's top hedge fund managers are ex-Goldman Sachs, ex-Morgan Stanley. They've all been prop traders at investment banks in the past. And then they've gone on to do the same function with outside investors' money, not the bank's money. The guys at investment banks are utilizing the bank's capital, so essentially that's shareholders' money, they're public companies. So let's go through some basics of a hedge fund. Well, why is it called a hedge fund? Because they use strategies that hedge out risk. So they can make money when the market goes up and down. But how is it structured? But it's just an investment vehicle for high net worth and institutions to invest in. And you have an onshore management company and an offshore holding company. And the management company charges a 1 to 2% management fee to manage the money, and an annual performance fee on the money they make using the capital in their positive selection portfolio. But what's very interesting about hedge funds is that when they go and pitch high net worth and institutions, as part of their pitch, and one of the conditions that investors have to invest in the fund is that in a given year, on the performance fee, at least half of the performance fee must be reinvested in the fund. No hedge fund charges a performance fee, takes their money and runs. They have to reinvest at least half of it.